Apple's position within the so-called stay-at-home trade, coupled with its status as a stable company with a massive cash pile, has helped Apple's shares hit record highs as investors have looked for relative safety amid the pandemic. That said, the stock isn't cheap. The company's forward price-earnings ratio currently stands at more than 25. That lofty valuation might keep some investors at bay, but Apple could also be a tempting stock based on current performance and promising longer-term potential. For investors who may be thinking about taking a bite out of Apple, here are a few points to consider. Many think the current market price for Apple's stock is well in excess of its fundamental value. Based on our fair value estimate of $98 per share, Apple's price, fair value is 1.34 times. As a comparison, in a ranking of the 12 most overvalued mega-cap stocks, Apple places fifth behind Tesla, PayPal, Netflix, and Nvidia. While we agree that Apple has good growth prospects and we have assigned the company a narrow Morningstar economic moat, reflecting its long-term sustainable competitive advantages, we think the market has gotten too far ahead of itself. Many believe the market is pricing in too high of a growth rate for the next 5 years and has over-extrapolated Apple's growth prospects too far into the future. Potential regulatory risk is hanging over Apple as its App Store has come under increased antitrust scrutiny. More broadly, Big Tech is facing increased political pushback as concerns rise about how much power companies like Amazon and Facebook wield. The App Store's 30% standard commission rate charged to developers seems to be the principal regulatory risk. The company cut that rate in half for smaller developers, with annual sales of less than $1 million. While those are the majority of publishers in the store, they accounted for less than 5% of the nearly $60 billion in revenue the App Store generated in the first 10 months of 2020, according to app analytics firm Sensor Tower. Investors project that revenue will leap by 16% in 2021. Apple's main revenue driver is the iPhone, which constitutes more than half of the company's sales. We're forecasting iPhone revenue will increase by 19%, consisting of a 15% increase in unit sales and nearly 4% increase in the average selling price. However, many investors don't expect this sales growth rate to last. Typically, unit sales surge in the year when new iPhone handsets are released and are slower in the off-cycle years when S versions are launched. The versions between the main unit upgrade cycles, typically denoted with the letter S, have modest changes as compared with the main handset upgrades, which are denoted by numbers, for example, the iPhone 12. It's crazy expensive, I would be worried, says Mike Bailey, Director of Research at FBB Capital Partners. His firm holds a lower percentage of Apple shares than the market as a whole. Although there is probably a low probability for fundamental disappointments, Apple's high P/E ratio means there's room for pullbacks if adverse sentiment develops. The current valuation of a mid-30s P/E multiple is the highest I can remember, says Tim Bain, Chief Investment Officer at Spark Asset Management Group. This makes the stock more vulnerable to broad market corrections and makes it increasingly difficult to exceed expectations. The bottom line: should you buy Apple stock? Investors are probably wondering how to weigh Apple's expensive valuation against its status as a high-quality company with expectations for continued growth. If you like what your research uncovers, you'll want to consider how Apple stock fits into the rest of your investment portfolio. Investing is all about diversification and asset allocation, two terms that involve spreading your money across various investments to align how much risk you're taking with your personal risk tolerance. Investing your entire portfolio in any single stock is considered risky. One run of bad luck for that company and your whole investment is at risk. Diversifying your investments across many companies, industries, and geographical locations can help reduce that risk. If you have any further questions, make sure you leave a comment below. If you'd like more daily finance content, then make sure you hit that subscribe button to join our community of aspiring entrepreneurs and investors.